Okay, welcome back traders. We're going to go through our module on unlocking the secret to span margin. First thing we want to do is just have a look at a couple of definitions. Our first one is initial margin requirement. Now this is the amount required within your trading account in order to open a specific position that you're trading. Now the other definition that we need to get across and be familiar with is maintenance margin requirement. Now this maintenance margin requirement is the minimum amount required in your account to maintain an open position as you trade that position or as you hold that position. Okay, so I guess you're asking what is span margin? Well, that span margin, the actual name is the Standard Portfolio Analysis of Risk, and what it is basically a highly sophisticated methodology that calculates performance bond requirements by analysing the what if scenarios of virtually any market condition. So how does it work, span margin? Okay, what span margin does is it evaluates overall portfolio risk by calculating the worst possible loss that a portfolio may incur over a specific time period. That's usually a trading day. And this is done by computing the gains and losses that the portfolio would incur under different market conditions. For example, a change in price, volatility, a decrease in time. So all those components go into making and calculating the span margin for your specific trading account. So each condition is called a risk scenario, and the numeric value for each risk scenario represents the gain or loss that the particular contract will experience for a particular combination of price, change, volatility, or decrease in time value, as we've already mentioned. And that basically provides you with what's called a margin requirement. So what we need to do as options traders is have a good understanding of how we can utilize this margin requirement or this span margin calculation to get the most out of our trading dollar. Ultimately, what's going to happen is our trading portfolio is determined, or the size of our portfolio, or the amount of capital we can trade in the market is determined by our margin level. So if we're able to control and better manage our margin level, then we're able to obviously take advantage of certain conditions in the market. So as spread traders, it's in our best interest to have a very good understanding of span margining. Okay, so our strategy, we combine selling options with futures hedge to, number one, protect our option positions. Number two, we want to take advantage of increased premiums during volatile markets. We want to avoid market timing because our spreads really want to be non-directional. We want to smooth out our returns, and ultimately we want to reduce risk, margin risk, in order to hold our position regardless of the market price. So when we talk about span margin, we know that from that previous definition that if there is a move in price, then that will basically impact on our margin. So if there's a move against us in price, or the market moves towards our strike prices, because remember we're selling options in the market, then we may be required to add additional money to our position to hold that position. However, if we're able to utilize our knowledge of span margin, then we may be able to control that margin risk, or the increased margin requirement that is often required by your standard option sellers. So let's look at our hedge summary. So very simply, we sell short-term options to collect premium and trade the futures market using our hedge line or profit taker strategy to protect our option positions. So what we do obviously is different to the way normal spread traders trade. We're not just looking to place a spread in the market, but we're also looking to use a futures hedge. Now, the advantage of using a futures hedge is that it also helps us to control and reduces our open margin. Is we're looking to hold our options to expiry while trading the underlying futures market to protect and make profit. Our advantage is that span margin recognises that futures and options traded in the same account have what's called a positive and negative delta. And what deltas do when you have a positive and negative delta is that they actually offset each other, and that helps to reduce the potential or perceived risk in the account. It'll assess the risk on that portfolio, and it'll see that we have an offsetting scenario occurring, and that will reduce our margin, open margin. So the advantage to us is that normally with spread traders, they have what's called a risk area, which is usually If it's, for example, a condor where they've sold positions that are out of the money and then they've bought some protective uh, calls and puts just above and below those levels, they still have spread traders do really well a lot of the time, but when they have a market that violently moves one way or the other, that obviously puts a lot of pressure on our standard spread traders because number one, they've got potential margin risk, and number two, they've got the risk of actually trading through their strike points, and that's where obviously they can give back a lot of premium they've taken. So you might have, say, 6 or 7 months of really good premium trading where you're taking in money every month, and then suddenly you get one of these moves that breaks through your strike price, your sold position, and that's a situation where you can give back a lot of that premium, if not all of it. So what we want to do is put ourselves in a position where number one, we reduce margin, but number two, we actually reduce the risk of being exposed to those large moves. Now, being able to use our futures hedging strategy, that's an opportunity for us to reduce that margin. So we no longer have the worry of having to potentially fund our account with additional funds. We just set our spread, and the requirement is that our basic assessment of the spread and the margin requirement won't deviate based on the combination of trading our futures and our options together. Whereas traders, that's really a very quick look at span margining. Now there is more detail contained in our span margining documentation, and I would implore you to basically look through that. The other thing you would definitely encourage you to visit the CME group, as they have their listed span margin calculators. So if you do get an opportunity, I would definitely consider purchasing the span margin calculator. We will be holding a couple of sessions on how to use that. It's a very powerful tool, and you'll just see by being able to calculate your own margin on these accounts what you can really do with once you get a good knowledge and understanding of span margin. So as I said, definitely have a look at the CME website. So that's cmegroup.com, and just go under clearing and risk management, and you'll see the span margin overview. So thank you for your time. That'll wrap up our session now on span margining. As I said before, there's more information contained in the documentation on unlocking the secrets to span margining. Go into a lot more detail. So thank you for your time, and look forward to seeing you in the next module. Cheers.